It's the first time that I have seen a private credit firm come in and offer exactly what the customer wanted in a speed that haven't seen commercial banks do that. Allowed them to basically take business away from commercial banks. Rewiring SME and corporate lending is basically fueling the economy, right? It's not about helping banks give that loan quickly. I believe that is a very exciting space to watch. You have these credit memos that are 20, 30 pages. We're seeing AI doing it in minutes now.
Private credit will eclipse syndicated loans by 2030.
Truth. Private credit are getting very innovative. They are very lean, and we're seeing much more of them entering the region. I believe that the biggest hindrance to legacy banks in corporate commercial lending is tech stack. No bank wants to do open heart surgery in this modern climate. In the next 5 years, banks are moving away from orchestrating around their processes to around orchestrating customer experience.
Reda Aouami brings a decade of experience working with digital banks and traditional banks across the region. Prior to his time at FIS, he spent some time at Mambu and Backbase. He's on a mission to deliver Lending 3.0, which is a mix of smarter data, AI, and modular cores that grow wallet share fast. Welcome, Reda.
Thank you.
Maybe if we can start off, talk about your experience in the past. When is the first time that you've seen kind of a challenger organization take market share from a traditional bank?
Great question, right? I think if I go back to the first time that I had seen that was basically when I was working with one of the banks that was specialized in SME lending, but they had a lot of processes and they were basically working with a lot of other banks to put together a deal, which was basically a syndicated deal for larger clients. They were not specialized really in that large commercial lending. So they did not have the processes to be able to work together with other banks to put together the syndicated loans. And by the time they were able to mobilize and get all the paperwork in place, it was the first time that I have seen in the region a private credit firm, which is backed by investors, come in and offer exactly what the customer wanted in a speed that haven't seen commercial banks do that. And that really triggered something, right? You could see that for the first time ever, banks noticed that alternative lenders using alternative data and being lean and quick to react to market into information out there that is openly out there, allowed them to basically take business away from commercial banks.
It's a big challenge, right? I mean, for the industry, you have this pressure on the traditional players, you have the tech game changers and enablers, and then you have the kind of embedded future. Some stats that came to mind, some analysts believe that the global alternative market is growing to be a $1 trillion market by 2028. In places like the UK, challenger banks have captured 60% of SME lending, which is a huge number. Yeah. And often SMEs are overlooked, but it's a big segment of the market. And at the same time, embedded finance is growing at 30% plus CAGR through 2030. So it's really going to change the nature of what's happening with lending. You brought up this idea of kind of lending 3.0. What does that mean for you? What do you see? And what's different from lending 2.0?
Yeah. No, I mean, just to take a step back, right? I've been in the industry for about a decade now and started off more working with banks around risk management, especially coming up from the credit crisis in 2008, 2009. There were a lot of regulations that came about. So I had firsthand experience seeing how banks were implementing to manage from a cockpit kind of standpoint, right? Managing interest rate risk, liquidity risk, market risk. And you could see during that period between 2010, 2020, where you started having these new entrants, so the neobanks or alternative lenders coming to market and disrupting the industry. So after basically I started off my career with FIS, then I moved to Mambu, which is a leading composable core banking or lean core banking provider. And that gave me firsthand experience to work with banks that were basically disrupting the industry, right? Where there was new banks and seeing exactly what they are bringing to market in terms of personalized offerings, embedded finance, but was more towards retail. It was a big topic a couple of years ago and continues to be in retail banking, but also gave me experience to see how incumbent banks are reacting, right? And how they are transforming themselves. And then basically, if post that, I moved to Backbase, which basically is about that whole customer engagement layer, right? How can banks adapt to what these neobanks and digital banks are doing by putting embedded finance in retail, basically at the point of need? And what I had seen there is banks were struggling to keep up and struggling to compete. And if you dig deeper, right, the reason for that is banks' core banking has been a hindrance for long term. So core banking is literally the core of the business or core of the bank. And we're speaking about incumbent banks having core banking that's 20 and 30 years old, right? Heavily customized where everything is happening there. So now that they want to act quickly, it's becoming a hindrance because there's no real-time data, unable to integrate, bring in external data. So that competitive advantage goes away. And we've seen banks transform slowly, right? If I look right now, as I moved back to FIS about a year ago, which is basically going back to that middle layer, helping banks transform commercial and corporate lending. And I believe it's a great point to be there because exactly what you mentioned, right? We're seeing this lending 3.0 transformation happening. If I'm to define that, right, lending 3.0 is your traditional lending, right, where it was a lot relationship-based, not paper-based, not much systems, not much auditability, etc. About 10 years ago, we've seen this transformation of lending 2.0, where banks were looking, okay, how can we have more auditability, standardization of financial spreading templates, having KPIs, seeing exactly where loans are getting stuck, trying to improve time to yes and time to money, right? Basically time to approving and time to disbursement. Now we're seeing banks trying to make a move to 3.0, which is really bringing in that predictivity and analytics. And it's quite interesting. That transformation is happening right now, right? If I look at some of the surveys that I've seen and some of the banks I've spoken to, Change the Bank, there's 40% of the IT spend is going into Change the Bank. And if I look at corporate banking, corporate lending, we're seeing about last year an increase of 4% of IT spend. And this year, the target is about 5 to 6%. So it's really transformation happening there. And it's exciting to see it happening firsthand.
Is that shift, that 4 to 5%, that's higher than you expect or lower? Or what would be normal for that?
Yeah, for corporate lending or corporate banking in general, that's higher than we would expect. If I look at the last 7 to 10 years even, banks have heavily invested in retail banking, right? Consumer experience, engaging with customers with a point of contact, point of touch like mobile, web, branch experience. Now we're seeing now it's moving a bit to SME and corporate banking transformation. So it's definitely higher than I have seen in the past.
And I mean, when you look at the segments of the market that are being affected by this, we talked a little bit about SMEs, you talked a little bit about corporates. I kind of have the impression that the SMEs are the segment that are really affected, but what about the larger lenders and borrowers as well? I mean, that corporate lending section of the market must be going through change as well.
Yes, it is. If you look at basically where banks' most relationships are with corporate companies, which is corporate banking, that's usually heavy relationship based, right? You have an RM who works with a company and they have very specialized ways of lending. That is going through transformation right now, right? We're seeing much more analytics coming into play. We're seeing, every discussion that I have with a bank right now, the topics are around lead management. How can we do more with our corporate customers, right? And bringing intelligence into that. How can we have systems having trigger points? For example, if there's a drop of cash flow or drop of balance where the RM can proactively go and provide a facility. Every discussion that I have with banks today, the topic is around wallet sizing. How can I increase the wallet size or basically the untapped potential of my customers, right? And we're seeing intelligence again coming in there. It could be as simple as basically, for example, if I have a customer that has 100 million facility with me, but in their annual report, the system detects they have $1 billion liability. So that's a 90% untapped business for us, right? So as the system will automatically trigger the relationship manager to go and say, well, here's the low-hanging fruit. Let's try to bring in that business into the bank, right? We're seeing a lot of discussion around what I would call customer 360 in corporate lending. Historically, again, an RM would wait for the business to call them, go understand what they need. They're trying to build a plant, they're trying to build a factory, understand what kind of loan, come back and process it and come back to them with a loan. Now we're seeing, again, bringing in intelligence and analytics to the RMs where, for example, a customer can have 360-degree view of the customer. For example, a bank in the Philippines, right? They lend a lot to conglomerates, which have multiple subsidiaries. And by utilizing this capability, just give you an example, there was a subsidiary A who basically do equipment and subsidiary B, which has real estate. And so when subsidiary A needed a loan but didn't have enough collateral, the RM was able to see within the analytics of the system that subsidiary C, for example, or B has an underutilized collateral. And of course, with the right paperwork and the right approvals, they were able to reallocate that collateral so that they can grow the business of subsidiary B. Again, being able to do more with what they have is everything that banks are talking about right now.
It's a great example because it's rare that your bank knows more about your business than you do. I think the traditional has been the reverse, and that's been my experience.
Correct.
And going to that point, I mean, you talked a little bit about legacy infrastructure that's kind of holding these banks back. The other challenge is deposit flight, right? I mean, you have digital banks, particularly on the retail side of things, but you have, there's been a lot of talk recently around Trust Bank here in Singapore that's, reaching profitability, which in a very competitive market like Singapore is a big challenge and a big accomplishment if they're able to hit that. What do you see as the biggest challenge for traditional banks? Is it deposit flight? Is it the technology stack in the background? How do those balance, and where do you see the challenge for the organizations?
I mean, I had first-hand experience working with digital banks in the region, Philippines, Malaysia, Vietnam, Indonesia, right? I don't believe they're a threat to incumbent banks beyond the retail side of the business.
Yeah.
None of them has been able to, Singapore, you have one or two examples, but none of them have been able to really grow into that complexity required to service corporates and SMEs. But even within the retail, right, last stats I've seen is 9 out of 10 of them are still not profitable, right? Whereas banks basically are able to offer their customers, especially when it comes to SME and corporate lending, it's not about deposits and loans, right? It's about supply chain financing. It's about being able to do international transfers, payments, right? Which banks are able to offer all these services that maybe a digital bank is not able to do. I believe that the biggest hindrance to legacy banks in corporate commercial lending is tech stack, right? Going back to core banking, right? If I look at banks today, all the conversation I have with banks, right? There's not a single wholesale banking head or a credit head that's not telling me they want to transform, that they want to innovate, right? There's more they want to do. But when we dig deeper, we understand there's some limitations within the bank. 50% of the time, it's banks are unwilling to touch the core banking. I don't believe in the last 12 to 18 months, any bank that I've spoken to, any CIO is willing to transform, to do a big transformation, a big core banking transformation, right? No bank wants to do open heart surgery in this modern climate, right? And so if you look at it, you have these 20, 30 years old core banking platforms that are no real-time information, no APIs integrated. So trying to bring in this intelligence, trying to bring in AI, this kind of analytics becomes a challenge. And this is where we really try to help them, right? Because I agree with most of the banks that transforming the core is a 5 to 10 year project, and sometimes it costs CIOs their careers, right, if it doesn't go to plan. But there are solutions, right, which I would call progressive modernization. You don't need to transform the core. What you could do, and we're seeing banks doing, we've seen large banks like Mizuho, the likes of JP Morgan, Standard Chartered do this, but we haven't seen the tier one banks in countries like Philippines, Indonesia, Malaysia do this. But reality is hollowing out the core, right? Instead of transforming the core, how can I lighten up the core? For example, have specialized loan management systems for corporate and SMEs and move those loans and those capabilities out of the core into a specialized system, have specialized limits management system. This then allows me to build intelligence, loan origination, all we've spoken about, wallet sizing, release management on top of this tech stack that allows me then to be nimble and to react to the customers. I believe that's number one challenge, so the tech depth, but then of course there's a solution. And a lot of times when we speak to banks, they identify that this could give their core another 10 years. And instead of having a 5 to 10 years transformation, we can have ROI and get them running in 1 to 2 years.
What is the best form of ROI to convince management, both on the business side and the technology side, to move forward with something like this? Because ROI is a key measurement of any of the success of any of these programs. Yeah. And as you mentioned, many heads have rolled for failed tech implementations over the years. And I started off my career at Citibank, so I experienced that as well as core banking migration. What is the ROI that resonates, particularly in commercial lending, with the business and the technology side?
If I look at it, banks within 12 months, they're looking for a quick business ROI, which could be time to yes or improving time to money, right? So having those KPIs improved. It could be seeing, looking at how much time they spend with existing customer, right? If you're an existing customer, why does it take 15 days, 20 days to approve a loan? It should be automated. We should be able to pull in information from other systems, right? And quickly have some automated systems. So banks are looking how much an RM and senior credit analysts are spending time on existing customers versus new to business bank customers, which are more profitable in the long term, right? So that's one ROI. Turnaround time and how to improve that. And third thing is long-term IT cost, right? Am I able to bring down the cost? Am I able to transform and have agility in my processes?
When you look at the different sectors that many of these commercial banks play in, is there an area where traditional banks will still maintain their advantage? Where it doesn't matter so much about having an old tech stack or being slow. I kind of get the impression that it would be more on the larger client base. So some of these corporate banks that are servicing the MNCs, and the MNCs aren't as demanding necessarily about whether their loan gets approved immediately or if it takes a day.
Yeah.
What segments of the market in terms of industries do you think that traditional banks still have an advantage?
I think you mentioned it, corporate lending. I think those big MNCs where you have a large relationship, right? well, it's very hard for them to move, right? There's a relationship manager. You have a very deep relationship with customers. Banks offer beyond just lending. You have supply chain financing, right, which allows you to basically finance invoices from your internet banking, etc. They offer FX, cross-border bank accounts, right, different loans in different currencies, especially in MNC. You're doing business in Korea and Singapore and in Hong Kong. You need a bank that can allow you to transfer in different currencies, right, have limits across that. So I believe that's a very cost of change is high for these customers. SME is a space that I think is ready for disruption, right? SME lending. We understand that SME make up about 8% of businesses in the region, right? And they employ about 50% of most populations in this region. But it's the most underserved, right? There's a lot of talks about it. I believe that is the next big thing, and it's the most exciting part. And that's what excites me the most about, because if you think about it, right, rewiring SME and corporate lending is basically fueling the economy, right? It's not about helping banks give that loan quickly or have lower cost of lending. But if you think about it, that quick loan or that cheaper loan means that a business is able to hire quickly, right? They're able to build that plant or that factory quickly, which means the money and the economy flow of that, and it has a rippling effect, right? And I believe that is a very exciting space to watch.
Yeah, that's always been, we've experienced that as an SME as well, is that we tend to get the short end of the stick in terms of the customer service. You're either a consumer and you're kind of a mass customer of the bank that calls into call centers, or you're a corporate and you get a lot of attention from a relationship manager. But having a relationship manager as an SME is nearly unheard of. I mean, your relationship manager is your phone or your iPad that you're looking at your app with. Is technology the only answer to solve that segment of the market?
Yes, if I look at that space, it's being heavily disrupted by non-bank lenders, right? If I look at the Philippines, for example, you have some players like Allen Capital that are coming in, very nimble, able to approve loans in minutes and disperse in hours, right? And that's mostly heavily dependent on technology, right? But I think banks are acting, and banks still have an advantage because they are able again to offer much more services than just loans. And if I look at SMEs, right, it's interesting because I was having this conversation with a bank in the Philippines and a different bank in Indonesia, and they brought out the same thing, right? There's a big focus on how do they tap into the SME. It's a bit of an unknown to banks because how do you, especially in our region, right? The financial statements are hard to validate for SMEs. It's a lot of paperwork, etc. So that's where AI is coming to play. We're seeing AI coming to play there, right? AI being able to do document matching, identify if there's any fraud. AI having systems that are basically able to connect with GST or VAT and pull up data about real spending, being able to connect with credit bureaus, right? So that, again, bringing alternative data to beef up that data required to make a more sophisticated credit analysis. So we're seeing that space a bit moving, but I believe that is a space that's also being disrupted by a lot of non-bank lenders.
That's a great transition. I'd love to talk a little bit more about kind of the fixes, not just the Band-Aids to kind of get us through, but the fixes. And I guess with some of your previous work, you've had the opportunity to work with greenfield banks who have, built their tech stack from scratch. When you look at things specifically, I mean, going back to your risk management experience in the background, what kind of excites you about AI? Thinking back to that time when you were really focused on risk management, where do you think are the key opportunities for AI to make a difference in terms of risk modeling and making changes? I mean, I think there are some obvious ones that we can all think about just with our experience using some of these platforms and kind of pulling together data. But where are we today, and what excites you about the future of kind of the AI risk modeling and where that could be better utilized?
No, I believe I cannot think of a single meeting I've had in the last 12 months with a bank executive that AI was not a topic, right?
Of course, yes.
And it's exciting. And I think this was also backed with the FIS Harmony Gap report, which showed that more than 50% of the people we've spoken to believe that AI is the solution going forward, right? Whether it's just to optimize processes or help address market dynamics. If I look at AI today, whether it's risk management or also growing business, right? It has equal use cases, right? If I look at risk, and you have to balance the both, right? If I look again, the last 12 months, all conversations around AI have been, the most obvious is Gen AI, right? If you look at corporate to commercial lending, you have these credit memos that are 20, 30 pages. You have a senior credit analyst sits down, talks about the industry, the trends, the business, how the business is performing, etc. We're seeing AI doing it in minutes now. We're seeing AI being brought in, as I said, to validate documents, right? Making sure that documents are matching, making sure that there's no fraud or an inconsistency among the documents. We're seeing also AI right now being used in early warning signals, right? Going to thousands. So as I mentioned earlier, right, you have all these capabilities now of cross collateralizing among different subsidiaries, etc. But equally, you need to manage the risk of that, right? Early warning signals, AI looking at covenants and review this risk that has been identified. So AI basically it is balancing the both growing the business as well as the risk, right? But one thing I can confirm that is banks are not allowing or not open to having AI make decisions. AI is there to basically help supplement, but then there's still that human intelligence that comes in for decision making and final approvals.
So at the end of the day, there's still an Excel spreadsheet on the back end that somebody is looking at that.
Or basically, if for example, I take the credit memo example, right, where an AI can write a credit memo, but the final recommendation analysis is still coming from a person, right, from a senior. It's not outsourcing the decision making to AI, right?
When do you think that will change? Because I think, I remember my first transaction online, and it was so mentally challenging to get through that barrier of actually putting my credit card details into an online platform. And now it's all stored on Amazon. You just click and it goes through. And I kind of think about corporate, like a corporate treasurer in particular, that discussion 10 years ago was, well, we'd never use an iPad to do that or a mobile phone to do that. But now you have the apps are sitting on the phones and people are making decisions about large value transactions. When do you think that changes, or should it change even in terms of, humans on the back end making decisions around some of these?
Yeah. Great question, right? It calls for speculation, of course. And we know that banks have always been a bit conservative compared to other industries, right? Just because they're heavily regulated, right? There's a trust factor to it. I mean, we know AI is evolving on a weekly, monthly basis, right? But as long as you still have the risk of biases, right, of this hallucination, I don't see banks anytime soon opening up decision-making to AI. But AI is being used basically to help do any work that is basically repetitive or requires cut down time significantly, or at least predict, right? But then I don't see, I know there's a hot topic of everyone saying, is AI going to replace people? Is AI going to replace jobs? I don't think so. If anything, it just empowers people to make better decisions and faster, right?
So you're not worried?
I'm not.
One of the other things we talked about at the beginning was embedded finance, right? Yeah. And I think especially within Asia, when we look at Europe, there was the open banking regulations that kind of forced all of the banks to be a little bit more open on things. And in Australia, the same thing. But we really haven't seen embedded finance take off as much as we have in Southeast Asia around that. So I want to talk about that a little bit more. In a piece of research that I looked at, only 26% of firms say they effectively leverage embedded finance. Why do you think it's so low? Do you think it's just a question of timing, or we're just early stages in this, or is it understanding although we've seen a lot of traction in embedded finance in Asia, what are the next steps or stages that we'll see within this space?
Yeah. I think that the statistics you've mentioned align with what I'm seeing, right? It's not a hot topic. Embedded finance is a topic in retail lending. Basically, we've seen it. We've seen a few use cases that have been successful. But if I look at Asian lenders, by going back to an example I was mentioning earlier, is basically I was speaking to two banks, one in the Philippines and one in Indonesia, and about SME lending and SME banking in general, right? And it was interesting because the future looks like having basically, if you look at, you have your own business yourself, right? And I don't believe you have a CFO, right? You are the CFO, you are the businessman, you are everything, right? And most SMEs are like that, right? So unlike corporations where you have a CFO is planning, okay, we might need to take a loan, a line of credit, we might need a facility in the future. Usually business owners are just running the business day to day. So banks now are looking at ways of adapting, right? And one or two conversations I've had is, what if banks are able to integrate to business ERP systems and online banking? And the bank, using intelligence and using basically other tools, are able to predict what your cash flows will look like. For example, by looking at your ERP and looking at your online banking, which you have information to, right? They are able to see, for example, that this supplier doesn't pay you on time. The last 3 times he has paid on time, but you have all these salaries you need to pay. You have this outflow that is expected. So the system will automatically give you a pre-approved loan. And you don't even, before you know it, you just get a message from your bank. Here's a pre-approved loan. You can draw down on it. And it could be customized, right? It's not, here's a loan. it's approved. You have to pay interest the next 6 months whether you use it or not. It's basically pay as I use, right? You can draw down on it, you can repay it. And so we're seeing this is how banks are thinking, because that will give them alternative data that is not available today. They will have visibility into your financials, your ERP, which then allows them to proactively lend to you. And I believe SMEs are becoming open to that. If I look at 5-7 years ago when I spoke to SMEs, they were not very open to opening up to banks, right? For security reasons, for tax reasons, there are a few reasons, right? But now if I look at SMEs and business owners, they're actually willing to have the transparency if it means more liquidity, right? If it means having access to cash and having access to facilities that they didn't have before. And I think that could be quite exciting. And technology is there to allow us to do that today.
Looking at what FIS is offering, maybe this is an opportunity for you, a little bit of sales pitch on FIS's products and services. What excites you the most about what you guys are bringing to market on this? I mean, what is the product or service that you think within the lending space is really going to make a difference for these people, whether it's embedded finance or otherwise?
Yeah. What excites me the most is, as FIS, we're able to bring our customers the opportunity to orchestrate around their customer lifecycle. If going back to lending 1.0, 2.0, 3.0, right? If I look at between lending at 1.0 and 2.0, banks went out there and bought systems, but these systems were built, orchestrated around their processes. Mm-hmm. It wasn't built about keeping the customer's experience in mind. You had basically you could approve a loan in 3 days, but it takes 20 days to book it in a core banking so that you can disperse. As a business, that's 20 days too long, right? And that's where FIS comes, right? FIS is able to offer that systems, best of breed systems across the customer lifecycle, whether it's at origination, whether it's servicing, whether it's credit scoring, or managing the whole entire lifecycle, right? And what excites me is when I go to conversation with banks where they're saying, well, I have a core banking that's unable to allow me to do this transformation, right? Our systems are basically built on technology that doesn't allow you to do full transformation, right? We understand you cannot integrate with the core banking today. You don't want to do an open heart surgery, but possibly you can give you a use case. You want to do only credit generated AI, right? That can be a use case because with technology and microservices, we can have that set as a use case. You want to only do customer 360 use case. We can give you that within 6 to 9 months without having to go to that open heart surgery. So that excites me because we have a suite of solutions that really is orchestrated around the customer lifecycle, but also it is modularized in nature so that you don't have to do a big bang approach. You can show ROI. And I think 5 to 6 out of 10 banks that I speak to today, if they cannot see an ROI within 6 months, it's really hard for them to get approval for funding. Yeah. And being able to show them that is exciting.
Yeah, it's amazing how this change is happening. I mean, you have a customer base that, you know, if you're a corporate treasurer or a business manager at a large MNC, you're maybe not using TikTok or these platforms, but your kids are. And so you're seeing their, immediate gratification and immediate response on a lot of these things. And like it or not, this is trickling into the expectations we have from our financial services providers.
100%.
So now we actually have the infrastructure and the technology in place to be able to make these shifts. And for me as an SME, and who's been an SME for the past 20 years, is thinking about the better ways that we can get served actually really excites me because we have been an underserved segment of the market.
100%.
For sure, over the period of time. Myth or reality? Let's do a bit of a lightning round looking at a couple of points that I just want to put it out there, and then you say true, false, and give me your thoughts on it. First one, private credit will eclipse syndicated loans by 2030.
Truth.
Why so?
Private credit are getting very innovative in the way they're lending, right? They are very lean. They don't have the pressure of regulators, given that they're not lending against deposits, etc. And we're seeing much more of them entering the region. In the US, it's big. In Europe, it's quite big, but in the region, it's picking up. And so we're seeing also banks creating offshoots, right? So instead of lending with deposits, they're large banks, they're creating funds to basically allow them to be more reactive and creative in how they lend customers. So yeah, I'm quite bullish on that.
That's a huge topic, right? Another huge topic is ISO 20022, which we wouldn't have been able to get through the podcast without talking about. But ISO 20022 will finally make multi-bank loan servicing painless.
True. I believe that banks are looking at it right now. There's a lot of discussions, and I mean, if we look at payments and transfer and transferring in general, right, has been growing and being innovated every 2 to 3 years. So I truly believe that, yes.
AI obviously is helping, and there are SME loans that are being approved quickly, very quickly these days. But what about AI approving an unsecured SME loan in under 5 minutes within 3 years? Is that something that we'll see? Is that reality?
AI might not be approving it, but AI will be empowering banks to approve it within that time frame. Correct.
Okay. Yeah. And last myth or reality is around stablecoins, which, although not 100% germane to lending, it's a huge topic, obviously, with the Indian industry right now. Stablecoins will dominate cross-border working capital lines. Fact or fantasy?
My opinion, that would be fantasy. I still believe there's a lot of, especially with what we're seeing, right? There's still the trust factor is not there yet, right? Adoption is not there. There's a lot of negative news surrounding it. And I believe until that is clear and there's much more transparency, where maybe there's more regulation stepping in, that could pick up, but I don't think it'll be that fast.
Traditional payments still.
Yeah.
Yeah. Great. Now for the last segment of our podcast today, I want to talk a little bit more about the future and kind of what we're expecting to see in the future. When you look forward to 2030, which is actually only 5 years away from right now, what does the 2030 commercial lending stack look like? What is going to be there? What is not going to be there? Are there going to be changes in personnel? What do you envision 5 years from now in the commercial lending space for that, both on the technology side and the people side as well?
Yeah. I genuinely believe that in the next 5 years, we will see a big change on the way, like I've mentioned, like banks are moving away from orchestrating around their processes to around orchestrating the customer experience, right? We will see banks putting the customer in the center and saying, how can I service the customer at every stage of the life cycle, right? Where as a business, you no longer have channels, they're just touch points, right? But then you're getting seamless experience, whether you're picking up the phone, you're looking at your mobile, or you're walking to a branch, right? Banks are on that journey. There is tech debt in there, but this is the future. I believe in SME lending, as I mentioned earlier. I think banking will be much more integrated with the day-to-day business, and SMEs will be getting tailored customer experience, tailored facilities that are really built for their business, not built in a way that the system can take payments and charge interest rates, etc. But really facilities based on your needs and customized, because then technology is allowing banks to be creative, yet while managing risk and giving them visibility.
And enabling.
Yeah.
For the listeners, hopefully they're not listening at work. They should be doing their work. But if they're listening on their run or their drive home, when they get into the office at 9 a.m. tomorrow or 8:30 or whatever the start time is where they are, what should they be doing? What is the first thing that they should be looking at to ensure that they're ready for that 2030 vision?
Yeah. Depends with the listener, but if you are a corporate executive, I think watch this space. Banks are going to be tailoring the way they offer you services. It's going to be much more customized and personalized experience. If you are in fintech, there's a huge opportunity to collaborate with and collaborate with banks, right? We're seeing, for example, HKMA having all this, encouraging banks to have all this, what they call sandboxes, right? To work with FinTechs on AI, etc. So FinTech should be looking to collaborate. Banks are open to do POCs, tests, hypotheses, etc. So yeah, a huge opportunity to collaborate. And if you're a banker, I think the message is clear, right? Adapt to remain competitive, right? And change the mindset, right? I think in lending, one thing, much less now, but in the past, we've been having the transparency. People were not comfortable with it, right? Having systems in place, controls, people were not comfortable with that. But we're seeing quickly that culture is changing, where banks now are adapting technology because it is allowing them to service customer much more better and much more faster.
Yeah. And the competitive drivers are really pushing that as well.
Exactly.
In markets like Singapore, as well as across the region. Give us one embedded credit or embedded finance war story that's too fresh or too crazy for a press release. What is something that's really surprised you that you've seen from either a competitor or a traditional lender in your experience? We
work with a lot of banks in credit, financial spreading, right, to make decisioning. And there's a bank in the Philippines that they still do banking based on pure relationship. Because the grandfather was banking with us 2 generations ago, we continue to do business with them, and it's built on trust. And it's amazing the bank is doing really well building on trust, right? So there's also that component of culture where they feel that bringing in technology might give them a different result and to how they will lend, and they don't want that to jeopardize the relationship, right? So yeah, I think culture also play a big role in this.
Yes, in lending 3.0, maybe not as much, but
100%.
1 and 2 is extremely important.
Yeah.
Reda, thank you so much for being with us here on Rate of Flow. This has been a really interesting conversation and look forward to keeping in touch.
Thank you for having me.